And give me a max number of minutes as well. What?
45.
45, perfect. Perfect. I will endeavour to stick to that. But by all means, actually, interrupt me during if you want, because it's not. This is not an academic paper with a regression, with a testing a coefficient or whatever. It's a policy paper. That's the official term, I think, for a collection of rants. So by all means, if you have questions, if something's unclear as we're going through, or if you have comments, I don't mind them at all coming during. And even with that, I'm going to try and finish at a quarter to allow for Q&A or people to get on with their day jobs. So in terms of like a preview, if you want to have a snooze over lunch, the key point I wanted to make is that the most important metric if you're a housing policy maker is the elasticity of supply with respect to price. So because supply is inelastic in the very short run, demand shocks are going to feed through into prices. If supply responds, my argument is that it should respond one for one in terms of elasticities, or as close to one as makes no difference. That should certainly apply in the long run, and ideally the short run would be very short. So you're never going to get no short run. You can't get housing overnight, but there should, in a good housing system, in a healthy housing system, it wouldn't take time for supply to respond to extra demand. A sort of a common objection to that is that, well, that's all right in an abstract, but in reality, land is fixed in supply and finite. And therefore, in popular places, you're always going to have high house prices and just get used to it. Well, as I'll sort of briefly cover today, there's no evidence to support that actually the evidence goes the other way. That the only reason cities have high housing prices, even allowing for strong demand, is because of policy barriers. Unless you're very unlucky with geography and you're already a very large city. That's sort of a crude summary of the literature. So this is a regulatory monopoly, not a natural monopoly. This is not a sector we have to worry about I/O. I'll mention that again in a few minutes. So the key point for policy is then, if you think in terms of P minus C, price minus cost, and then you say, well, price depends on income, and some people may not have enough income, so we call it Y star. And then cost breaks down into the cost of building and the cost of land, CB and CL. So what I'm saying is policymakers, in particular Irish policymakers, if they want elastic supply, if they want supply to respond appropriately to demand, that they need to focus on the key relationships in here and sort of break that into different bits to focus on 4 key policy areas. If I were housing minister or dictator or whatever, those would be the areas that I'd focus on. So a quick outline, I'm going to spend 5 or 10 minutes just on the Irish context, sort of a common framework of what's right and wrong, mostly wrong, about the Irish housing system at the moment. I call it a theoretical framework. That's bigging it up a little bit. It's really more of a conceptual framework, a bit like the one, more or less the one I just outlined, and then breaking it into sort of 4 key relationships. What's the relationship between price, sale or rental price, and income? What's the relationship between the cost of construction, cost of building, and income? What's the relationship between income and the break-even income you would need to be able to afford housing? So that's maybe YI to Y star. And then the last, what's the relationship between the cost of land and income? So just a little bit on the Irish context. Some of you will be very familiar with this. Some of you may be less familiar. This is the picture of sale prices by region over the last 10 years. Sorry, this is the year-on-year change by region. What's roughly true is that the Irish market is, at least galloping by on a horse, it's one market. Once you allow for more than one market, yes, you could argue that Dublin, the blue line, is different to some of these other places. But overall, they're actually more similar than they are different. And once you get down that route, well, actually, some bits of Dublin are different to others. You end up sort of there's 400 or maybe 400,000 housing markets in Ireland. So regional differences do matter. If you stack this up by cumulative increases from lowest point since 2012. There's bits of Dublin that are up 70 or 80%, and there's bits of Donegal that are up 10 or 15%. So there are differences, but I suppose what I would stress more is that you're talking about commonalities. At least maybe it's limited to this period of extreme movements in national factors. Maybe the preceding 10 years will be different, but at least what we've seen over the last 20, 30 years is a national housing market with variations on a theme. The reason that you see dramatic increases and then a dramatic slowdown in inflation in Dublin, only to be relaxed again. The first is dramatic increases is the sharp, if you focus on the blue line here, the sharp contraction in availability on the market. I actually don't have the source here, but all this is underlying daft.ie data. So this is availability for the same regions. You can see a dramatic fall off in availability of sale properties from 2011, and then a corresponding increase in inflation from negative 20 to positive 20. If I were giving this talk 3.5 years ago, I'd sort of ditch the rest and say you need mortgage rules. You need something in there to take the expected capital gain bit out, because that looked remarkably similar to what was happening in the late 1990s, where some shortages in supply converted into changes in the long-term expected inflation rate in housing that fed through into both demand for credit and supply of credit. That the banks were working off double-digit inflation into the medium term. The other thing to highlight, which I'll come back to, is that between September and December 2014, expectations of house price inflation in Dublin dramatically lowered. So the 1 year picture went from 10 to 15% to 3 to 5% on average. That's based on a survey that DAF does every quarter of housing market participants. And more or less nothing else changed in the housing market other than the central bank announced they were going to introduce in the future loan to income and loan to value rules. They didn't say what they were going to do, they didn't say exactly when. It was going to be early 2015. But that one change took if you think of your user cost term in housing, your cost of carrying versus expected capital gain, crudely put, the expected capital gain went down. And that brought about a dramatic stabilisation in prices in Dublin. The 18 months after the central bank rules were introduced, the average for Dublin is 0%. There was no change. There was no fall, but there was no change. Drilling into areas, it's a little bit different to that. They relaxed the rules last year, and I won't say it's causal, but it's in there. It's in the causal mix that there was a 10% increase in prices in the first half of this year, just after they relaxed the rules. That looks like that's all. The picture from the third quarter is very little change in the third quarter. The exact same picture, but for rental, you can see that the fall is sharp but narrower. It took place in a shorter period of time, and effectively, if you think of this as having two parts of the housing crash, the first part was the real economy bit, where unemployment was higher and incomes were lower, net migration had turned to net emigration. That had an effect on rents and on prices, on rental prices and on sale prices. The second bit is the yield correcting, that actually, aside from the real shock that the financial side, that a 3% yield on housing is just not high enough to account for the risk that comes with holding something like Irish housing. So that second dip you can think of as being the yield correcting from roughly 3% to roughly 6% in gross terms. That's the annual rental income as a fraction of the sale price. I suppose focusing on what's happened since, the increases in the rental market have been steadier and longer and cumulatively greater in Dublin. Off the top of my head, cumulatively greater in most parts of the country, I won't say all. The increase in rents in Dublin 7, I think, is about 85%. And in Dublin 8, it might be close to 90% at this stage, from their lowest point in 2010, 2011. And again, it's the same picture of reduced availability. There are little spikes that correspond to students starting college, but the scales are obviously very different. but you can get a sense that the fall off in rental availability is far worse than the fall off in sale availability. If you view, I've been consistent on the time, but if you went back with the daft.ie availability of rental stock, if you view 2002 to 2005 or 6 as roughly normal in the rental market, it's hard to find a period that is normal, but if you view that as something like normality, there were about 5,000 properties on the Dublin market, rental properties on the Dublin market at any point in time. It's now 1,000. So about a fifth of the availability that seemed normal 15 years ago, and 15 years ago the rental sector was only 2/3 of the size it is now. So healthy in Dublin at the moment in the rental sector would be something like 7,000 or 8,000 properties on the rental market at any one point in time. What we're seeing is 1,000. So there's a huge challenge there around housing supply for rent.
So where have they gone? Have they just been sold?
So I'll get to that in, this is sort of getting onto that picture. The short answer is that renters aren't moving. Because rents are going up, if you are a renter, you stay where you are. You don't. But that itself assumes something about over aggregate demand. And aggregate demand is increasing. And this is sort of the line I would use to shock a policymaker. They're aiming to get to 20 or 25,000 units a year. They think they're at 15,000. The BER certs suggest there are about 5,000 new homes built last year by the professional construction sector, not 15. So instead of going from 15 to 25, my take is that they have to go from 5 to 50, or certainly above 40. And the reason I think they picked that number because it was somewhat achievable from 15 to go to 25. So they could turn around at the end and say, we did it. If you actually look at the numbers, a natural increase alone will get you that. But that's only one source of demand. A second source of demand is demographics. That we've been going from 4+ people in the average household down to 3. We're now below 3. We're clearly on a journey that every other European country has made to something like 2.2 or 2.3. In some countries it's down as low as 2. But we can't make that journey unless the housing is there. So roughly speaking, if we were to go from 2.7, we're at 2.75 now, down to somewhere in that range, say 2.4, we'd need 10,000 extra homes every year for the next 15 years.
But the homes might be smaller. Each unit might, as you move to slower household size, you kind of make units smaller.
Yeah.
So the effective number might be different.
If you're measuring it by euro, I think that's an important point. If you're also making a point about repurposing existing stock, there's some validity to that. I think I'm going to agree with you in a couple of slides' time in terms of what we need. The other two sources of demand are obsolescence. Even in a country like Italy, which has no natural increase and no change in household size, they still need to build because of obsolescence, and some of that's to do with internal migration, that if people are going to the cities, then a rural cottage is not going to work. Ireland has a sort of bimodal housing stock. Lots of really new stuff and lots of really old stuff. And the really new stuff is in the cities, and the really old stuff in the cities and towns, and the really old stuff is rural. So sort of a moderate obsolescence rate is another 10,000 a year. And then if you've net migration of 20,000 a year, as we did last year, every 100 migrants is 40 dwellings. So you have another sort of 8,000 homes to add in there. And you could say, well, that's an optimistic assumption. That's true. These alone get you to 40,000. It's whether it's 45 or 50 or 55,000. If I wanted to do optimistic assumptions, I'm sure I could engineer the figures to get to 60,000, but I'm not sure I'd believe it. But I certainly believe that below 40, you're missing something.
Or you're obsolescence. I mean, isn't building a new home different from renovating a home? Obsolescence is referred to renovations.
So obsolescence isn't that well understood in housing because you've depreciation of your asset and at some point it falls off. The assumption in the national accounts is that we lose about 0.75% of the housing stock every year. Now, whether that's depreciation of a home that 0.75% of it wears away, or the homes that survive depreciate by less, and there's some homes that fall off. Clearly some homes fall out of use. We'll actually have a better handle of this in a couple of years' time. The census and the Department of Housing and the electricity ESB networks are working together at address level to figure out who disappeared between 2011 and 2016 and why. but I'm going to make the case that at least some housing will just fall out of use. And the reason I believe that is because we've housing distribution that's skewed to older rural properties. This is, I think, getting to, well, why, you know, where do all the properties, where have they gone? This is completions measured by electricity connections relative to household formation in the Greater Dublin area alone, just in the intercensual period. And this is the households that did get formed. So these are the ones that were able to find somewhere to live. So I'm going to skip past this because you can see there's a shortfall of about half. So there's 25,000 connections, electricity connections, about 48,000 new households formed. But both of those numbers are wrong. Electricity connections are not housing completions. And the household formation that happened is not the underlying demand, it's the stuff that was able to find a household. There may have been plenty of households that wanted to form but couldn't find a dwelling to do it. So that's what that slide is saying. So you plug in some numbers, and the slides, if they're not circulated, they will be circulated, so you can challenge me in due course on the numbers. I think the true estimate of demand in the Greater Dublin area is about 1,200 a month, and that's with pretty negligible net international migration. That's just based on sort of a moderate picture of the economy. And these are the commencements. This is the building activity started, which is a better gauge, I think, of what happened. This is from 2011 up to 2016. You can see there's a huge gap. Probably for every 4 households for which there was underlying demand, maybe only one dwelling was started. So to a bunch of economists and social scientists, the point I want to make here is that the elasticity of supply is not just below 1, it's almost 0. That you're seeing. You could argue, well, what's happening here? So it's not 0, definitely. But for far too long it was 0, even when it was clear that there was demand for housing. The population in Ireland never decreased year on year throughout the last 10 years. It always went up. That alone creates demand for housing, as does obsolescence, as does demographic changes, even if there's net emigration. So we needed the homes and they weren't built. Now, I think this goes to your point, which is that often we elide from housing to houses. The point I want to make is that actually housing does not equal houses. That we have a surplus of, these are rooms in this, dwellings in the census that have 5 to 7 rooms, 5 to 7 principal rooms. And these are, you call them 3 to 5 person dwellings. And these are the 3 to 5 person households. So we actually have a surplus of about 160,000 family homes in this country. It's just there are not families living in them. If you think about where the students in UCD live, a lot of them are going to live 4 or 5 to a 3-bed semi-D. If you think about where a retired couple lives, there's plenty of them around here, they live 2 or 1 to a 3 or 4-bed semi-D. Skip forward to the opposite. They're different colours, at least I'm claiming they're different colours. This is 1 to 2 person households, and these are dwellings with 3 to 4 principal rooms. So an apartment, a 1-bed apartment with a living room would have 2 principal rooms. A 2-bed apartment with a living room would have 3 principal rooms, and a 2-bed apartment with 2 living rooms or a living and a dining room would have 4 principal rooms. You can see the deficit of about 500,000. I'm calling them apartments, of course. They don't all have to be apartments in apartment blocks. I'm going to call them apartments for simplicity. Some of these are going to get met by rural houses, but the vast majority are going to get met, of this demand, if it ever is met, is going to get met by urban apartments in some form, whether there's high-rise city centre apartments, mid to low-rise suburban purpose-built student accommodation, reasonably low density assisted living complexes, whatever it is. We're going to have people living in lots of other, I think we should hope to have people living in lots of other forms of accommodation 50 years from now compared to where they live now. So just one statistic, we've 10 times as many single young people as studio apartments. And there's a sort of a clear demand push in other countries to build co-living and studio apartment type arrangements. And they're actually more or less prescribed under Irish regulations. You can't build them. this point gets repeated in a minute. So this is just an international comparison. We have 12% of our dwelling stock in apartments. The Shetland Islands is up at 16, and you go all the way up to Italy at 65, or Poland or Germany at 55, or the UK at 50. And this is Dublin, 24% in apartments, and then a bunch of other cities, including Belfast, are 50%, or indeed 2/3 or 3/4, and in Bilbao, closer to 90% live in apartments. So we not only have a shortfall of apartments compared to our population structure, we have a shortfall of apartments compared to our peers. So you can't really make the case that we're different, and we have the same population structure as other European countries and cities. We don't have the same dwelling structure. We're an outlier, not in demand but in supply. I'm conscious of time, so I don't want to go too much into the figures here, but I'm going to make the case that we never built enough urban apartments, not even during the Celtic Tiger. So this is cumulative dwellings completed in the decade to 20 years to 2015. These are the urban or Greater Dublin area apartments. So this includes anything built in Wicklow or Louth or Kildare or Meath that's an apartment. And it's, we built twice as many rural one-offs as urban apartments. So when you actually look at the numbers, if you annualize this and look at this was predictable in the mid-1990s. We knew our demographics were going to smaller households. We knew we were urbanizing. We just didn't build the housing for that. And the excess housing is almost entirely, at least we'll come back to this, but the excess housing is almost entirely in areas with no major metropolitan area. So the Upper Shannon has 25% of housing there is vacant in some parts, and it's a mismatch of supply and demand rather than a classic oversupply per se. This is urbanization on the right hand side. We're the least urbanized high income country. And that's not a labour market story, that's a housing market story. That we're actually much more similar if you look at where the jobs are. Jobs cluster in cities. We just force people to commute long distances to the jobs. So the number of people commuting an hour each way went up by roughly 1/3 just between 2011 and 2016. So I view that as completely unsustainable. If the jobs are going to be as concentrated as in other countries, but the housing is going to be spread out across the country, I don't think that's a viable option. That's my policy position. There's a question, why are we so bad at building apartments? My sense on this is that we're the only country in the world that was smaller in 1990 than it was in 1850. Like every good Irish talk, the answer is either Guinness, St. Patrick, or the famine. In this case, it's the famine. This is Irish population change by decade, averaged out 1850 to 1980. And you can see that this light green line is to get compared with these pink lines. Every other European country grew. Now we actually face strong population growth over the next 6-7 decades. It's the Eurostat forecast. So we're going to add roughly 5% a decade. So the swing we have is a 10 percentage point swing. Every other country in Europe has a slowdown in their population growth in the 21st century compared to the 19th and 20th centuries. So my version of this is we didn't build apartments because we didn't have to, because the population was declining. We never built up that expertise. In fact, we lost the expertise that we had in the 19th century and early 20th century around building what is now called multifamily. But we have to get it back because, I hope it's the next slide, because I'm going to skip to the next slide. Yes. If we take Eurostat's population projections, and they say 6.2 million by 2080, you could argue that's relatively modest. It's a what is it? It's like a 30% increase over 6 or 7 decades. It's a 0.5% a year. That's what they're predicting for Ireland. And you plug in that by then Ireland is 80% urban. So Ireland at the end of the 21st century is only as urban as the rest of Western Europe is now. And Ireland's average household size is only as small at the end of the 21st century as it is in the rest of Western Europe now. then, just by simple maths, we'll need 2 million apartments. We have 200,000. So it's an apartment block every week until all of us are dead. So long run, apartment block every week for the long run. That's my sort of sense. Now, apartment block hides the within apartment block variation. You're going to have, as I say, high-rise, student, assisted living, downsizer, suburban apartments, all that kind of stuff. But that's the sort of scale that the housing minister or housing policymakers need to be thinking of. And this is what we built. So 800 per month is what we need. It's what I'm saying we need. We built 300 a month in Dublin in the 90s, 600 a month in the 2000s, and less than 100 a month in the 2010s. So we've had an elasticity problem around building apartments. That's almost entirely what we need. And it seems to be getting worse, not better. You might argue maybe this is a transitory factor, and that's hopefully the segue into the rest of the talk. So there's a hell of a lament on those slides. I appreciate that, but the narrative, I guess, is the important thing. That we've got a growing population, and due to not only the growing population but urbanization and demographic change, not only do we have a backlog of unbuilt, in particular urban apartments, but this is going to persist into the long run, to the Keynesian long run, long after we're all dead. If there's anything was unclear around that, let me know now, or else I'll proceed. So the cost of housing, thankfully, for somebody like me, is becoming an increasingly popular research topic for economists. So obviously, Piketty had his book trying to point out that wealth income trends were unsustainable, but the Ronley critique is that if you separate capital into land/housing and the rest, the bit that Piketty worries about, he barely talks about property or housing at all. He sort of said it's a form of capital, but basically this is about shares and financial assets and so on. But Ronald said, well, actually, you strip out the housing stuff, the trend disappears. What are you worrying about? So somebody like me might read that and say, sort out housing and you sort out the rest of the stuff, at least much of the rest of the stuff. And Christian Hilber, who's at LSE, has done some work where they look at local authority specific data, and they look at the refusal rate for major residential projects as a regulatory barrier to supply, and they estimate that in 2010 prices in England would have been 35% lower and more in the south of England in real terms if all regulatory constraints were removed. That's obviously a sort of a static hypothetical exercise, but that's their estimate of how much is a regulatory premium that's caked into English, in particular, English house prices. And then it's working paper at the moment. Enrico Moretti and Zay have basically tried to calculate the GDP effects of the labour mobility impact of housing supply restrictions. So what their argument is that in the US, housing is your barrier to mobility. If you can't afford the housing in a high productivity city, you'll be stuck in a lower productivity city than you otherwise would choose. And the sort of cumulative GDP effect of that is that the growth rate was half of what it could have been over the last half century because of these effectively labour supply mobility restrictions through the housing channel. That's their argument, and there's plenty of people who argue with their argument and pick at the spatial equilibrium model they use and so on. But it's clear this is a topic academic economists are at least taking seriously. Probably one of the seminal papers in the area is Albert Saiz's paper looking at the elasticity of housing prices to demand as a sort of a way of getting at the supply curve. And what he found looking at this sort of 30-year period, 70 to 2000, and incorporating quantitative measures of the geographic barriers to supply and the regulatory barriers to supply, and using, as much as possible, exogenous demand shifters, he found that the beta on a shift in demand, once you allowed for geographic and regulatory barriers was zero. That there should be no price response to a demand shift, because the supply should come along and meet that and drive price back down in the long run. Not only that, so you've got two categories of barriers now, geography and policy. The geography barriers only kick in when your population is big enough. So my contention would be that in Ireland, no city is big enough yet that it's bumped into its geographic constraints. You're talking about cities in order of magnitude larger in the US, where that might be the case. Like Miami is water constrained quite a bit. Boston is an interesting case. They've reclaimed an awful lot of land. So clearly you reach a point actually where even that constraint, I think about half of Boston is reclaimed. So it's not a non-trivial amount. And the last literature I'll mention is a book by William Fishel called Zoning Rules. And he sort of builds on this story, which is not just, you could read this and go, those bloody planners, why do they keep bringing in these regulations when they're welfare destroying? Well, Fishel's argument is this: you can't blame the planners or the councillors, particularly if the councillors get re-elected for having done this. So actually you have to look for the demand for land use restrictions. So the demand, he goes back to the 1910s and 20s and looks at the first wave of land use restrictions. That's when zoning ordinances came in first. And then the second wave since the 70s. The first wave, that's sort of a window in, that technology enabled mobility for industry and low-income households to move into the suburbs or to the wealthy areas. Wealthy residents didn't want that and came up with a way of stopping that effectively. The second wave of land use restrictions builds on that, but is the unexpected inflation in the 70s created wealth for people whose debt was frozen, and now their house is worth more. So they had wealth that they realized that this is actually, if you can keep house price inflation high, you sort of fade away your mortgage debt. So with the majority owner-occupiers in many municipalities in the US, and the municipalities are much smaller than the cities, that leads to significant land use restrictions.
It's basically rent seeking by the homeowners. They're saying
yes.
Young people.
Yeah, is Aidan here? Got into a row with him on Twitter recently. Not a row, a polite discussion on Twitter recently about this, that he was making the case, a sort of a classic Marxian case, that capital is driving changes in housing policy at the moment. And I was trying to make the case that the people who benefit from really an elastic supply are the homeowners. Actually, capital and low income often have an alliance the other way, that they will want land use restrictions reduced, but yet it's rent seeking.
But how do homeowners benefit from that?
Well, once you're in, it's in your interest now that you live there to stop potential residents lobbying for more supply. I benefit because I own a house, and if house price inflation stays high, then my asset, it's the dominant asset in my portfolio, therefore I want house prices to stay high. As Colin McCarthy says, if nobody's going to vote for what's needed, if it means their house price falls in value by 50%, which is probably roughly what's needed. There's obviously a bunch of theory underpinning all those papers. My sort of skeletal economic theory bit is just right back to Econ 101. My maintained assumption is that where price is greater than cost, housing supply will respond. So I'm making an IO assumption that there isn't a cartel in housing supply. The evidence for that, on the basic evidence is that, well, empirically this seems to be true. That housing supply does respond when it can. In the Irish case, we know that the majority of housing supply are these sort of ad hoc firms that form to build a one-off house and then disband. Right? So it's not like, that's not a cartel. There's maybe a cartel in rent seeking of some sort of stable oligopoly or something. But on the supply side, rather than the demand for regulation, there's no constraints to building a home. Anybody can set up a construction firm, and many people do. So where P is greater than C, supply will respond. And then adding three important details. P is a function of Y. The willingness or the ability to pay depends on people's incomes, so affordability matters. A distribution of Y exists at any point in time. Some people are going to have high Y or lower Y. If there's some cut-off income, then there's going to be people that are always going to be below that. And policymakers want to worry about that. And C is the build cost plus the land cost.
Oh, sorry, Ronan. Are you treating the land cost as exogenous here? Like, I can understand if you have P greater than C sub B, that would be the normal Tobin's Q type thing. But obviously the whole thing of no bribing people to rezone and so on. C sub L is an exogenous.
Yeah, I'm not assuming, it's not formal enough a model really to assume the exogeneity or otherwise of CL. But in the final part, I get to that. I think it's not. We don't have a functioning land market, so there's definitely this is not exogenous. But I think with a small policy measure, you could make land significantly more abundant and cheaper, and effectively get it to closer to its marginal cost, which is very low. That's a fair point. I'm going to leave aside. I'm going to sort of happily skip from sale to rental price and skip over any discussion of yields or cap rates or whatever. If that really troubles you, let's bring that up in Q&A. This is important, obviously, but I don't think it's important in terms of this setup. So these four relationships. The first is having a safe mortgage market. So what's the relationship between a sale price and an income? So this is data that I assembled while visiting the central bank, part of my doctorate, and it's micro loan data, but it looks at the median first-time buyer loan to value and the median first-time buyer loan to income. Different scales, obviously, from 2000 right through to 2012. And you can see the big increase there is this period from 2003 up to 2006-07. And that's where the banks decided to give people 100% mortgages, or certainly the median person was getting a 92% mortgage, and we're getting close to 5 times income at the worst part. And the potted history of this is that up until the 1990s, the building societies had got a preferential tax status not to do this. So they would go bust. They were not too big to fail. They would go bust if they lent dangerously. So they put in place what we would now call macroprudential rules. They wanted to become banks, though. They got their way, got gobbled up by the banks. The banks had no experience in giving out mortgages other than what they acquired through the building societies. And then we ended up with 100% mortgages and so on. And then in the 2010s, we've got loan to value, loan to income rules back again. My assessment of this from a policy perspective is 90%-ish correct. This is about managing demand, not anything about supply. So again, if there's stuff you want to talk about, can I suggest we'll come back to this at the end. The only thing I will say on this is if I were designing it, I wouldn't have LTI in there, because I don't think LTI is a good way of rationing across space, particularly when you've got land use restrictions. You can have LTI if you have no land use restrictions, but putting the two in together doesn't make any sense. People will just pile up on petrol and time commitments to top up their mortgage, so they'll just move further out with their fixed amount of mortgage debt they can borrow, get a bigger property and drive more and pay people more for childcare. The second wrinkle that I don't get, and the central bank has never been able to explain this one, is why first-time buyers are treated differently to the rest. So first-time buyers have a 10% deposit, the rest have a 20% deposit. The central bank say, well, our big data set shows that first-time buyers are a lower default risk. So that's what the big data says for whatever 2002 to 2012. I tell you what, we'll snooze that. But why? Was it something to do with that period? Is this something that's going to persist in the future? It makes no sense to me to have two sets of rules. But I they're wrinkles. I'd much rather take them as they are than say, let's scrap them. Because if we hadn't got them in, I think we would have ended up in very similar territory now, with 25% inflation 3 years ago.
So it's a selection effect. First time, I asked somebody in the central bank about this. So it's first time buyers are different sort of people.
that the idea?
Well, no, well, what they were arguing was that somebody aged 40 who's a first-time buyer with a certain income and a certain job and a certain spouse and a certain income and a certain job is lower risk than somebody also aged 40 with a similar pattern of covariates. The only difference being the guy in one of them bought in 2004 and has got out of negative equity, the other didn't. You could argue they're structurally different people, but is that going to persist into the future? It's not obvious to me that we need to have two completely different regimes for what looks like an artifact of big data. If they could explain it theoretically, I'd buy it. In other countries, it often goes the other way, that your step into the property market is more dangerous than the rest. So you have a bigger one. I could see the theoretical argument for that too. I just think whatever they do, they need to justify. And I haven't seen a good justification of that one yet. But I suppose I wanted to spend the bulk of the next few minutes talking about the next two items. The first is a construction sector. So what I have here is the average rent for each of the main markets covered in the DAFT report for the two-bed apartment a couple of months ago, and they go from 500 up to 2,000, and then there's three lines. The top line is estimated viability for apartments in terms of break-even monthly rent if you've got 100k per unit inside costs. That'd be the max you'd pay for an apartment typically. There might be a couple of sites where you'd pay more, but that's your sort of max. Your min obviously is estimated viability for apartments with zero site costs. So your break-even range for an apartment is in here, and you can see that Dublin 1, Dublin 2, Dublin 4, and Dublin 6 are in there. South County Dublin is just viable. But if you're trying to build apartments in Cork or Waterford, well, not. Nobody's trying to build apartments in Cork or Waterford because even if they had zero profit margins, no VAT, free land, etc., they're not going to be able to cover their costs. It's as simple as that. The third line is if you leave out basements. So you cut off a fair whack if you have 3 to 4 stories, which means you don't need a basement, versus 6 stories where you need one basement car parking space for every unit. And I suppose the one sentence summary of the next 5 minutes is all of the troubles, the regulatory barriers that have been introduced on the cost side, not the land side, but the cost of construction side. They're basically on a premise that all additional regulation brings benefits but no costs. Of course, regulation can bring costs as well, and nobody has done any regulatory impact assessment of what these changes to regulations mean for low-income households, or in this case, households outside of Dublin 2 and 4 and 6. This is to show that this is not, there is an issue around the overall construction sector. This is the percentage supply response in hotel rooms, office space, and purpose-built student accommodation in the 5-year period 2015 to 2020 compared to apartments. So whatever it is, you could argue these are also inefficient, but whatever the level inefficiency across construction in Ireland is, the brickies are paid too much or whatever, that there's something unique to apartments that's making it significantly worse, with basically no supply response. And given we have a shortfall anyway, there's no shortfall in office space. The new office space is there to meet new demand. We already have a shortfall of apartment space, and it's not happening, let alone meeting the new demand. This is the best data I can get so far on what goes under the hood in the per square metre construction costs. So Dublin's about 40% more expensive than there's Amsterdam and Calgary in Canada. And it's true whether you leave in VAT or take out VAT. All 6 of the headings, Dublin is, and that these are the ones that quantity surveyors would use, Dublin is expensive when it comes to building apartments. So it seems to be unique to construction of apartments and then across the board once you get into construction of apartments. And part of this, I think, comes from the cookie-cutter nature of planning now. Is if you want to go build apartments, they will tell you how deep the balconies have to be, the orientation of the apartments, the ratio of bed space to storage space. They'll tell you how many lifts per floor. They'll tell you how many basement car parking spaces. They'll tell you how many floors. There's no discretion, really, for the idiosyncrasies of every site. Every site is unique. It's differentiated in some way, but there's no leeway to account for that. Then there's a challenge there. Related to that, suppose the break-even rent is €2,000 for a 2-bed apartment. Well, let's look at the Revenue Commissioner's figures on incomes and plot the households in Ireland by their income. And I've converted it into monthly and then a third or 35% of their monthly gross income. So you can see that only the top 10% of households could afford a minimum spec 2-bed apartment in Dublin. That's the regulatory impact assessment bit that's missing. It's great to have the world's largest minimum sizes, but if that means that nobody can afford it, nothing's going to get built, and you're not going to have your policy will have basically been self-defeating. So, if you wanted, this is the social housing bit, what if you wanted to support the bottom third? Well, that suggests you need to get your 33%, you need to get your break-even rent for a 2-bed apartment down to something like 500 or 600. Now, you can make this exercise a bit richer by looking at 2-person households versus 1 person and so on. But I don't think it's going to change too much given that the median household in Ireland is 2 persons. So with the, as I started veering into overtime, I just want to walk through one sort of mathematical example and then I'll finish with some audience participation. So I'm going to take maybe 3 more minutes, apologies. So this is the, if we think about, so it's one thing to make construction more efficient and that you'll bring this line down, but what do you do for the people below this line? You can't assume that they all have access to some existing stock and don't need your support. So my idea of how you bring in a right to housing is, let's put some numbers in here about how much it costs to build. That's your total excluding land. You can convert that into a monthly rent. A household, 2 adults, 2 kids, earning 45 grand, doesn't have enough to cover this 1,300 a month break-even rent. They've only got 1,000. That's their disposable income that they can spend on accommodation, roughly a third of their monthly disposable income. So they need a subsidy of 300 a month just to afford a minimum spec 2-bed. If you think of this as a universal income or negative income tax story, well, it's obvious what you do here. You have your housing subsidy targeted at this number, but I mean, we can't be subsidising above average incomes 300 a month just to afford housing. So you need to think about getting efficiencies. If we can get the hard costs down, change the minimum sizes, the minimum break-even rent now is 800, not 1,300. This household, not only can they afford the minimum, they could actually afford significantly more. They could afford 75 square metres. Previously they could only afford 62. And you could only build 80. That was the sort of the gap there. And that's the sort of the kernel of the universal housing subsidy idea, is that whether it's a grant or whether it's a negative income tax, and obviously a negative income tax is going to be cheaper, is that you respond to households' means. I've got another example in there of a single person, but by doing that, you sort of flip on its head the provision of social housing. Currently, it's like, please, Mr. Developer, will you please put 10% of your units aside for social housing? We need to meet our social housing requirements. That's the last kind of policy you want to be doing for social housing, because it's going to be pro-market, pro-cyclical. If you had, Dublin City Council has their Devoney Gardens. If Dublin City Council said, okay, non-profit housing bodies, tender, and the main criteria is going to be the quantity and quality of social housing units you put on. I don't care what happens to the rest of the site. You give me 250 good quality social housing units, you probably win the tender. And suppose someone comes along with 275, perfect. What that non-profit housing body has done is gone to a for-profit developer and said, build on this site, I'll take a 25-year lease, or I'll take them off your hands straight away, 275 of your units. How much are you going to build on the site? It's the pre-let. This is what they do in the commercial space. They have a pre-let and they go off and raise the capital. The for-profit developer now has pre-let and can go and get the finance. And that then puts social housing at the start rather than at the end, makes it counter-cyclical rather than pro-cyclical. It also means that if you get an income increase and you go above your threshold, you don't get kicked out, that the housing body can choose to keep you at market rent rather than turf you out. And in principle, they could put in a sort of an ownership structure. The audience participation time, this is the last graph, honest. This is the ratio of prices of housing in Dublin to elsewhere in the country. And you can see that before 1990, there isn't really much of a Dublin premium. These are Department of Environment data, they're not mix adjusted, but that's what you want in this case. The sticker price of housing in Dublin is the same as elsewhere. You get a bedroom less, a smaller garden, whatever, but you can buy a house for 10,000 months in Dublin and 10,000 months elsewhere. Since then, it's gone up. I stopped in 2004 because the Department of Environment data go funny after that. If you do the same thing now, it's about a 75% premium. So the premium for living in a big city in Ireland is just an artifact of the last 30 years. Why? Audience participation time. Does anyone know this site? Cormac's having a good look there. So it's on the Lewis, but it's on the Red Lewis line. It's the old Lyons tea factory out near Inchicore. Does anyone know what's going in there? The National Ambulance Centre is going in there, next to a Lewis stop. Ambulances don't fit well onto Lewis's. I'm not an engineer, but I know that much. And who sleeps? Does anyone know what that is? Anyone live near the North Circular Road? That's McKee Barracks. So in McKee Barracks, does anyone know who sleeps in McKee Barracks? The Dublin Equitation School, or the Army Equitation School, the horses sleep in McKee Barracks. There are no soldiers sleep in McKee Barracks. So, I mean, that's just two examples of brownfield, sort of brownfield. Very good point. So we've got really bad use of existing sites. We've Cahal Barracks as well. We've got the Dublin bus depots, which are basically the Dublin United Tramway Company depots, fast forwarded. Lots of golf courses, yeah. I presented to a housing body once, and I used golf courses as an example, thinking this would be a favourable audience. And the guy came up afterwards, he's on the board, and he said, yeah, great points, yeah, and interesting one about the golf club. I'm actually captain of Elm Park. And I was like, who? So I steered clear of that one. And then, like, it's not just brownfield. This is 1,000 acres inside the M50 at Dunsink Observatory. You know, we can move an observatory to Burr Castle or something. You know, you don't have to have an observatory with a huge radius around it. And then most cities have moved the report a couple of times. Dublin has once or twice, but not recently. There's about 25,000 homes that could go in there. They'd also be high value because they have a coastal premium. But that would be if you wanted to fight. So I'll finish on that. I think the policy, you can see the policy directions in terms of specific policies. It's an audit of construction costs, find out where we're out of line. Housing subsidies, move to a universal income varying housing subsidy. Land use, I mean, this is a no-brainer. All economists should support a land value tax, right? It's inelastic in supply. Politically, get rid of private homes and farms, but everything else, public, commercial development, and as I say, mortgage regulations. If I got the other three, I'd die a happy man. But hopefully in 2080 after we've built all our apartments. So thanks for your time and attention. Apologies for going over time, and look forward to any comments or questions.
Okay.